timing options. Some that look at abandonment, like can you exit the project before it completes, right? If you have the option to do that, does it add value? Flexibility. If things are going really well, could you kind of, like in a poker game, could you double down on your bet, right? If things look like they're going well. So flexibility option, or excuse me, a growth option. So we're gonna look at those. And hopefully we'll have time and I'll bring up what's an option pricing model, not for you guys to go back and replicate it, just to show you how different inputs in the different real option inputs affect the value when we change them, right? So, all right, let's look here at 14.1 to get started, where it's got Kim Hotels. So part A is just a basic NPV. There's no option in it. It's just the standard math you guys have been doing. The option comes in part B, and they're telling us it's going to be a timing option, okay? So let's look at what part A tells us first. It says, let's see, Kim Hotel is interested in developing a hotel in Seoul, Korea, or South Korea. The hotel would require an investment of $20 million, produces cash flows of $3 million a year for 20 years, cost to capital is 13. So it looks like this. We pay $20 million today, and then each year for the next 20 years, we get $3 million bucks. The rate is 13% on this thing. And so our NPV for this is going to be $1.074 million. So if that was the only thing they were asking, this project looks good, we should go ahead with it, right? That's what it would tell us. So we should accept the project. Okay, the option is described in part B. Let's see what it says. So Kim expects the cash flows to be $3 million a year, but really, so first off, the cash flows of 3 aren't really what they think they're going to earn. They're the average across 2 different possible scenarios. So we'll see that in a second, okay? They say that the cash flows could actually be higher or lower, depending on whether there is a hotel tax, which they'll know about 1 year from now, okay? So right now, the hotel tax, which will be either imposed or not imposed, will happen in a year. Today it's uncertain what's going to happen, but in a year's time we'll have certainty, we'll know, okay? There's a 50-50 chance of it being imposed or not imposed, tax or no tax, 50-50. If there is a tax, the cash flows are $2.2 million a year, right? With the tax date. If there is not a tax, the cash flows will be $3.2 million a year. By the way, let me show you something real quick. So you guys have done expected values before. And all it is you sum up your probability times, normally it'd be a return or something here, right? In this case, since the expected value is going to be a cash flow, it's going to be times our cash flow. So if you've got a 50% probability of getting 3.8 million, and you've got a 50% probability of getting 2.2 million, you work that out and you get those, and then you sum these things up and you get 3.0 million. That's the number we had up here, right? The 3.0. But the real cash flows aren't 3 million a year. They are either 3.8 or 2.2. Okay? Now, I'm going to digress real quick on this problem. Let me do it over here. What if you went and did the following? You did a scenario analysis for this problem. What if you said, here's my decision tree. We start out today, we pay 20 million. And in a year, we get 3.8 every year out to year 20. And of course, we've got a discount rate of 13%. what's gonna be our net present value? Well, in that case, the NPV is going to be 6.7 million. Okay? That's the no tax scenario. On the other hand, a tax could be imposed. So years 1, 2 out to 20, drop the cash flows down to 2.2 million a year, right? So for 2.2 million a year, in that case, the NPV would be minus 4.5 million. I'm rounding a good bit here, but you get the basic idea. So in one state, it looks like a good project, in another, it looks like a bad project. If you multiply these by the probability, this is what we were doing back in an earlier chapter. If you have scenarios, you do the NPV for each scenario, multiply by the probabilities, and then sum all that stuff up. So that times 0.5, that would be 3.35. That times 0.5, that would be minus 2.25. And you work that out, and if I hadn't had if I had been a bit more precise here, I would have had exactly that number there. I know that's gonna be 1.1, that's from me rounding, okay? So I would have had exactly the number over there. So in part A, they're really doing a shortcut. They're giving you the expected cash flow, not the cash flow in each scenario, right? In other words, those average out to 3 million. So we worked it for 3 million and we gotta go. Over here, I split it out like we did in a past chapter to each of the scenarios, and I worked out the math the long way, and it says go ahead, go with it, right? It says the expected NPV looks good, so this is a good investment. Right, again, no option yet. All I did, I took information from part B and I split out my scenarios. Now let's go and analyze this timing option, okay? So here's what I haven't read yet. Kim is deciding whether to proceed with the hotel today or wait a year to find out if the hotel tax will be imposed. If Kim waits a year, the initial investment will remain 20 million, no change. Assume all cash flows are discounted at 13%, the same number we've been using. Should Kim proceed today, wait a year, or avoid the investment? So let's work out part B and let's see how it looks. And you really should compare part B to what I just did over there, okay? Compare what I'm about to draw and work against what I just put over there. So here we are today, times 0. Here is a year from today. And here are my 2 branches. No tax. And then the lower branch was my tax branch, right? I didn't put that over here. So no tax and tax. And we know that there is a 50-50 chance of either branch occurring, right? Those are my probabilities. And so then I'm gonna put my cash flows up here. Now, I've got to be careful. It's still 20 years of cash flows, but they've been pushed out a year. So it doesn't start in year 1. That's where my initial payment to start everything is going to be, right? I'm pushing it out. So that means that this 3.8 isn't in year 1, it's in year 2. The next one is in year 3, and the last one isn't year 20, it's year 21. Same thing on the bottom branch. So those start 2 years out and they go to 21 years out, and they're that lower cash flow because of the presumption we get a tax. We're going to use 13%. That's the capital there. Okay, we've got 2 ways of working this. One way is you could just dump your what's the cash flow today? 0. And you could, for each unique pathway through this tree, like we did last week, you want to compute the net present value, right? So what's one pathway? The upper branch all the way through, right? 0 minus 20, 3.8 for 20 years. You could do that in your cash flow calculator, get the NPV. So if you do that, then you should get the following. NPV should be 23. Oops. I don't. Hold on. Okay, so the NPV should be 5.924. Here's an easy way to get that number, just a quick little trick. Since these cash flows are the same as those cash flows, except they're just out 1 extra year, discount it 1 extra year, which means take that NPV, 6.7 million, and discount it for 1 year. And that'll give you this NPV here. In other words, 6.7 divided by 1.13, 1 plus your discount rate. That's going to give you this number. Just a quick look. If you're like, I don't like that, just go back and put the 0 minus 20 and the 3/8 all the way through and get it. Okay? There's that number. Multiply by our 50%. And that's going to be 2.962. Be a little bit more precise this time. Bottom branch. Let's get that one. Here we get a minus 4.023 times our 50%. We get a minus 2.011. And if I were to go add all that stuff up, I would get 0.951. But I have I did something incorrect. I'll let you guys finish putting all that down, then I'll tell you what I have that's incorrect. Okay, so it almost looks like by waiting a year, my NPV is lower than it was over there, right? So it looks like I shouldn't wait a year, but I have an error here. Why are we waiting a year? We're waiting to see if there's a tax or not. And so I will know today I don't know which branch is going to unfold. So I put them both up here because they're both possible to happen in a year's time. But in a year, I will know which branch is unfolding in front of me before I actually pay the 20 million. That's the whole point of waiting a year, is to resolve the uncertainty. And that means that I will know that there is either no tax, in which case the project looks good, or there is a tax, in which case the project looks bad. Why would I go through the investment if I know for certain at that date the project looks bad because there's a tax? So I wouldn't do it. That would be 0 because I'd walk away, right? That's the whole idea about timing. Wait and see and avoid the bad outcomes, right? That means that's 0, and that means that our expected NPV is actually that number right there. It looks a whole lot better, and it's because of what we're doing with this timing option, with the wait and see. So let's see. This one over here that we did is if we invest today, it has a positive NPV, right? This one looks better. So what is this? What do you think the interpretation of this is? What should we do?
Wait a year.
We should wait a year before we make a decision. Wait 1 year before deciding. Now why? This is a positive expected NPV. Why don't I just simply say, we'll do the project in a year if there's no tax? Because right now, I don't know, right? Right now, I have no idea if there's gonna be a tax or not. It could be the bottom case, right? So all it simply means is, because waiting to get resolution of that uncertainty increases the value of the project today, I should simply wait a year to see what happens. So here's how you look at a timing option. So this is with the option, right? NPV with it, 2.962. This is the NPV without the option, right? 1.074. So let's do the following. Let's do a couple of things with this. Let's say that the NPV without the option. So let's see, we had, I'm just gonna put the numbers up here. 174 NPV with our option, so including the timing option. So it's 2.962, proper decision. Wait 1 year and see what happens. Incidentally, in a year's time, the cash flows could be completely different. The discount rate could be different. So so it's not just a matter of will the hotel tax be imposed or not, we have to recompute everything. We have to re-estimate all the cash flows and everything else, right? Before we do this. We'll have to do that really quick after the tax decision or after the hotel tax decisions come out. Let me put some other hypotheticals up here. What if we had had 1074 without the option, but waiting a year had done this? Let's say that waiting a year had given us an NPV with the option of 0.4 million, 400,000. What would you do?
Did you say you would still go with the 400,000?
How come?
Well, I mean, if you're kind of gambling on that first one without the option, but with the option, you at least know whether or not you're
If you
profit.
gambled, if you went to Shreveport to the casinos, you would always play the odds in your favor. And the odds in my favor are where the expected values are higher. Because this takes into consideration the good and the bad scenarios. This does too, but allows us to resolve that uncertainty. They're both positive. But this one says the gamble is more than worth it here because the value's higher. So here, accept today, invest today, right? What if we had this? I know it's not worth investing now, but because there's a timing option, it actually makes it a doable, it makes it worth waiting to see what happens with the tax. So this is gonna be wait, and I'll just put ditto, ditto, ditto. It's the same thing as A up there. What would we do now?
Never
Don't bother.
Yeah, reject it. Just walk away. Reject the project. So you see what I'm doing. I'm to wait a year. I'm looking for this NPV to be positive and to be higher than my NPV that doesn't include the option. And that means let's let's utilize a timing option, let's wait and see what happens. But if, say they're both positive, or heck, this could even be negative right here, as long as this number is positive and higher than that number, go ahead and go to the investment today. Down here, they're both negative, so it doesn't matter, we just reject it out of hand. It's not worth doing in any situation. It's not gonna make us enough money. Let's do one last thing, and then we'll move on and look at another problem. If I take this NPV, let's do it up here. If I take my NPV, with my option, so that's the $2.962 million that we computed there. And then I take the NPV without my option. That's the initial problem. So let's take the difference in those two numbers. I get an option value of 1.888 million. So in other words, the NPV of 2.962, which told us, let's wait and see, has the original NPV in it, plus this extra component, this extra amount that made it higher, this premium. That's what the option did. It raised the value by that much. So why is it worth knowing what that option value is right there? Well, let's say that I am, I'm the mayor of Seoul, South Korea, right? And the city owns the land where that hotel will go. And so what's one thing that's important here for Kim Hotels is they can still get that land, and hopefully the price won't rise, right? So maybe I can go and guarantee them that, yeah, the land will still be here in a year. You don't have to buy it. We'll give you a year to make your mind up, and I'll still sell it to you at $20 million. But I'm gonna charge you a fee for that privilege, for that option, right? I'm gonna charge you, this is the same thing you have in an option, right? Where you are charged a fee for buying the option price. So how much could I charge here? Well, could I charge you guys, if you're running Kim Hotels, could I charge you $1 million? Yeah, I could charge you $1 million, because even if I took $1 million out of this, it's still better than that number right there. Could I take $1.5 million out? Yep, I could. It's still gonna be higher than that right there. In fact, I'm seeing something going on here. As long as this number is higher, or at least no less than this number right here, I could probably extract a good bit out of you in this fee. How high could I potentially raise this before you're kind of indifferent between them? By the option value, right? I could charge you a fee equal up to that amount right there and extract that out. Do you think that ever happened? Yeah, when the federal government in the U.S., we got 5G now, the network. Before that happened, federal government auctioned out the bandwidth for 5G. In other words, the federal government decides it owns the bandwidth. Someday we'll have 6G, I guess, and 7 and 8G, I don't know. Maybe we'll go to a different letter instead of G, right? But they auction it out. And so the federal government has economists that compute out the option value of that bandwidth. And they set up auctions when they auction this stuff out, and their aim is to try to extract that option value from AT&T and Verizon and T-Mobile, from those companies, or whoever's going to bid for that bandwidth. Okay, so there's that. So that's a timing option, okay? The decision isn't invest today or invest in a year. It's invest today or wait a year to see what happens.
Good on the test, would you ask something like find the NPV with the option, then NPV without the option, and then like a quick question of like, what's the option value?
Yeah, that could potentially happen.
Alright.
That could potentially happen, yeah. Yeah. It'd more likely be like, remember the original problem was pretty quick?
Yeah.
We had the same numbers over there. It was the same thing, right? But you'd have to work through this one here to get that number and then take that difference. That's very conceivable, right there. Let's see.
Actually,
Okay.
one more question.
Yeah.
Why did we make that 0 again?
Because remember, we're waiting a year,
Yeah.
timing option. And the only reason we wait a year, so first off, forget this right here, put everything back up here. If we waited a year, but in a year's time, regardless of which pathway unfolds, we're committed to the project, whether it's a no tax or a tax. That would be the value. It's less than that one because everything's pushed out a year, it's being discounted more years, has a lower present value. So it wouldn't be worthwhile to wait on a good project unless there's something that comes from waiting. When you wait, you get a lower present value, your cash flows are further out. So the value of waiting is the resolution of which these two pathways will unfold. And so that looks good, we would do it, that looks bad. We would simply choose in a year's time not to go.
Okay.
And as I say, not to go and purchase the land from the Korean government and build the hotel and everything. We simply choose not to do it. Okay, that's a timing option. We may have some more of these, let's see. Let's look now at 14.3, where we've got Wansley Lumber Co. Is that the one that I want to do? Let me see something real quick. Yeah, so Wansley Lumber Co. Considering the purchase of a paper company requires an investment of $300 million, should provide cash flows of $40 million a year for each of the next 4 years. Cost of capital is 13%. Should they purchase? This is basic NPV, ignoring any option, okay? By the way, they say timing option. This one doesn't have a timing option. It's going to have something else. We're going to figure out what it is in a bit, okay? So let's write this one out. Let's see what we get. Okay, so this is going to be A. This one is costing us $300 million today. And then we get cash flows for the next 20 years. And they are $40 million a year. And we are once again discounting at 13%. Okay, so we want the NPV for this. Would this be good or bad if we went ahead and did it today? Let's see what we get here. And, excuse me, we get a minus 19. It's like 1901, something like that, right? So minus 19 million. We would not do this project now. It's not worth it, okay? All right, let's go over to the next page. This is where things start getting interesting. Let's look at B, all right? Look, just B, forget C for right now. Wansley realizes the cash flows in years 1 through 20 might be 30 million a year or 50. 50% probability of each. This is that same thing I did with the other, right? The cash flows could be either 30, that sounds bad. There's a 50% chance of that occurring, so 15, or they could be 50, 50% chance of that occurring. That's 25. You add that up, you get 40. We were using the expected cash flow there, like the other problem, right? But the real cash flows are either 30 or 50, not 40. Okay? So keep that in mind. So we're really going to have a tree that looks more like that thing right there. So let's do that real quick. Let's change this into a decision tree environment that really reflects it. So let's do this starting right now. So here's 1, 2, out to 20. Upper branch is gonna be the better branch, 50 million a year. The lower branch is gonna be the worst of the branches. And that's gonna be 30 million every year. And then of course we spend 300 up front at times 0. And so if we do that, let's get our NPV for each of these two scenarios or decision tree branches. So the upper one is going to be an NPV of 51.24 million. There's a 50% chance of that occurring. And so that is 25.62. That's the probability times the NPV. Do the same thing for the lower branch. And for the lower branch, it looks like this. It is minus 89.26 times 0.5. Now, I can't zero this out because this is I go now or I don't go now, right? No option here. So that times 0.5 is going to be a negative 44.63. And I net that with the 25.62. And I get minus 19 again. Expected net present value. So real quick, just a quick aside note here while you guys are catching up on the math. When you've got a problem like this, that's a decision tree scenario analysis, you've got two ways you can work it out. You can either get the expected cash flows and just do the regular NPV on that. Or you could do a decision tree where each branch is a scenario, get your NPVs times your probabilities, add those sums up or those products up, and that's going to give you the same number. Two different approaches get you to the same end result. Now, there is one byproduct though. This gives me more information right here that the other approach didn't give me. That approach may be quicker. I don't know. One of these approaches may be quicker than the other, but I do have some more information here. So let's see what's going to happen to this. And this may help me add in the option by having the tree split out like this. Okay, so let's see what else they tell us here. So we had the cash flows, right? We had the 30 million and the 50 million. Let's see, because the nature of the purchase contract, Wansley can sell the company 2 years after purchase, right? Year 2, for $280 million if it no longer wants to own it. I guess they're going to sell it back to the original, to whoever they bought it from, right? Let's see. Assume all cash flows are discounted at 13%. So, it almost looks like it must be a timing option because we're pushing everything, well, excuse me, we're not pushing everything out. Let's see what this one's going to look like. So, this one isn't a timing option. It doesn't say we're going to take 2 years to wait and see. It simply says in 2 years' time, we can walk away if we're in the project, right? So we're not going to wait. And you say, well, why would this even matter? The project looks bad. We just walk away from it now anyway. Well, let's go evaluate this one. It's going to be interesting. So let's see. This one's going to take a bit more thought, okay? So let's do this branch by branch. Let's say the upper branch. Let's analyze that. So I'm just going to analyze this thing right here with, that's a horrible with our option, and this is an abandonment option. Right, we have the option to walk away at the end of the second year, abandon the project, okay? So we've identified it's not a timing option, it's an abandonment option. So let's see what's gonna happen here. So I'm just doing the upper branch only. That's all I'm gonna do. So here's what it's gonna look like. Today, today, a year from today, 2 years from today, right? 300 million spent today. We get 50 if we're on the upper branch. Don't erase, I'm just gonna drop this down a little bit, give me some more space, that's all. Okay, so we spend 300 today, upper branch, we get 50 there, and then we get 50 plus, we walk away, and it says we get 280 for selling it. So we get a total of 330 in that year. I can add those two because they occur at the same day, okay? So my cash flows are minus 300, plus 50, plus 330. Those are my cash flows. Let's get an NPV. All right, so with those cash flows there, that gives me 2.7 million. I'm not going to interpret it yet, right? So upper branch, we get 50 million a year, but we walk away from the project after 2 years. If you're sitting there thinking, why would we do it? Come back to that in a minute, okay? We walk away after 2 years. We get 2 years of cash flows from the lumber company, plus the revenue from selling the lumber company, or the cash flow from selling it. Now let's do the lower branch. With the option. So with the option, the lower branch will look like this. So we still have today, a year, and 2 years from today. Today we spend 300. A year from today we get 30. And then in 2 years from today we get 30 plus the money from selling it. So that's going to make for 310 out there. All right. Let's take our 13% discount rate and let's get a present value or an NPV of all that stuff. Right, so here we get an NPV of minus 30.68 million. Okay. We've done a lot of math. We're about at the point where we can start putting all this together. All right. Let's look at the upper branch again only, okay? But now let's do this. Let's look at the upper branch. We carry the project to completion. This is to completion, okay? So, branch, upper, NPV, if we carry to completion, 20 years. NPV is 51.24 million. Okay? NPV if we abandon it. In year 2, NPV is 2.7 million. They're both positive. We could walk away in year 2, but it doesn't make any sense because from our perspective today, we get more value carrying it all the way to completion. So that means between those two, I'm going to use that one right there. It's the higher. In other words, from today's perspective, if we wound up on the upper branch, we would carry this project all the way through 20 years instead of walking away in year 2, because we get a higher value carrying for 20 years. Okay? Let's look at the lower branch. We're gonna do the same thing. Carry to completion, that's the original project going out 30 years. It has a negative 89.26 million. Not good. If we walk away after 2 years, it's still negative, but it's minus 30.68. Now, on this one, we can't simply, let's make it 0. This is in the timing option. We're gonna, if we do the project, we're committed to it, and either branch could unfold. But if we're on the lower branch, from today's perspective, it looks like we would walk away in year 2. We'd exercise that option in the contract to abandon the project. So that looks better. So those are my 2 NPVs that I want to use. Okay? So let's go take this and finish it all up. Times my probability, 0.5 and 0.5. I'm gonna have to erase a little bit of this here. And so 51.24 times 0.5, that's that number there. That is the 25.62 we got a while ago. But now, on the lower branch, I'm not gonna do this. I'm not gonna keep taking these low cash flows when I can walk away in 2 years and the overall loss is mitigated. There's still a loss, but it's not as bad. So this is gonna be minus 30.68 times 0.5, so minus 15.32. And that's gonna leave us 10.3 million expected net present value. Yeah.
15.34.
Where'd this one come from?
Yeah,
Probability times that NPV.
but it's 64 divided by 2.
68.
Or 68.
So that would be 4 there, and this would be 2.8 there. So. Huh. Without the abandonment option, it's not a good project. With the abandonment option, it is. Right? We can cut our losses and run in the event of the bad scenario unfolding. It doesn't make the bad scenario good, it just reduces its negative impact and lets the good scenario have more influence over the results. What do you think the decision is here? What should we do?
Accept it.
We should accept now, right? And this isn't a timing option, this isn't a wait and see. This is, do we go ahead and invest now or not? So, yes, we would invest now. If we said, no, NPV with the option, 10.28 million. Then we got the NPV without the option, where we're kind of stuck. That's the minus 19. And then we have our option value, which looks to be, what would that be? 29.28 million. So it's that the abandonment option is everything that's driving this to be a good project, right? That ability to cut our losses makes this a good project instead of an awful one that we walk away from. And you see something else that's important. The decision is different here. Not because the numbers are different, because an abandonment option is still invest or not today. Whereas a timing option is go today, wait, or walk away completely, right? Those 3 possibilities. This one is either yes or no now, right? It's yes or no now. All right. We're not going to work C because I want to go ahead and do another problem while I've got time. But let's just take a look at it real quick and just think about it. Kind of remember one of the 5 methods I put up here last week was a qualitative analysis. Remember that? Kind of like, let's just see how we feel about it. Let's see how we feel about this one. So, we can wait a year. This is a timing option to find out whether the cash flows will be 30 or 50. In other words, if it's up here, the NPV will be lower here's what will happen. They wait a year, 2 years, this will be lower by 2 years worth of present valuing. This will be 0 because they'll know not to do the lower branch, right? So that'll be 0 right here. So, in fact, we can do this real quick. I'll show you the number. If we, part C would be wait 2 years or not. It's a timing option. The expected NPV will equal, I'll do it for you real quick. 25 to 2. It's going to be 20.06, and this is going to be 0 right here. So that's what it's going to be, 20.06. Okay? We don't have to do it qualitative. We can actually do the numbers here. Okay. So let me highlight 3 items up here. Here's the original. No option. Here is with the abandonment option. And here we have a timing option only. So first off, so what do you guys think? What would we do in this event?
Timing,
So
the timing option.
the timing option, which means I'm the boss man, but I have no understanding of finance whatsoever. I'm a lumberman. I brought you in, so what does this mean? We're gonna see what's better. You're right, but what does it mean? How do I approach this? Do I go and invest right now?
No, you should wait 2 years.
We should wait 2 years, right? We should wait and see. Like, why didn't we just go ahead and do it now, knowing we can walk away in 2 years' time with the abandonment option?
Is the NPV, we expect NPV is lower?
It's positive, but it's less than the timing option. Yeah, exactly. So here, we couldn't add the 2 options together. We could do either the abandonment option or the timing option. First off, without these options, it's not worth doing at all, right? With the abandonment option, it made it positive, 10.28. But the timing option, we can't walk away though. The timing option raised the NPV even more. So this looks like the better alternative right here, because that number is the highest of them all. But it doesn't mean we're gonna accept now. It's like the Kim Hotels, it means we will wait 2 years to see what happens, right? So now our decision went from invest now, then we can walk away in 2 years, to wait and see what happens, right? So now we know what we're gonna do. Okay, let's see. Let's do one more of these things. Let's do this one here. Growth option. Okay. One quick thing. You guys are reading through the chapter. The authors will talk about things that we know for certainty. We discount at the risk-free rate. That generally is true, but we're not going to do it. We're going to discount everything at the cost of capital just to make life simple. If we start mixing discount rates, we've got to pay attention to that, and that takes a lot of extra time. It doesn't add a whole lot to what we're doing. Let's just use the cost of capital for every single cash flow, okay? So keep that in mind. Let's see what we've got here. We're looking at basically buying a franchise, right? It's a 2-year franchise. The franchise fee is $20,000. That's our upfront cost. And then we get 2 years of cash flows. We have 2 different scenarios that we don't know which is going to unfold. Either good demand, 40% chance, or not 50-50 now, 40% chance of good or high demand. Cash flows are $25,000 a year for 2 years, or low demand, bad demand, 60% chance. Cash flows are only $5,000 a year for 2 years. Cost of capital is 10%. Let's work this out without any kind of option being added in here. So this is going to be kind of this is our base analysis right here, right? Ignoring any options. Let's draw this out. So our 2 branches here. So this is our good demand, this is our bad or low demand. Our fee is $20,000. I'm just gonna put everything in 20, right, in thousands up here. And then we get 2 years of cash flow, and that's it. So either we get 25,000 a year, or we get 5,000 a year. And our discount rate is 10%. Okay, so the same procedure we've been doing. We get an NPV, multiplying by, for each branch, multiply by our probability, add those two products up. We've got our expected. Okay, so the upper branch is going to be 23.4. This is in thousands, and the odds are 40%. That's going to be 17.36. Then the lower branch is going to be minus 11.32. And that's going to give us a negative 6.79. Let me recheck that. Okay. Okay, so that is 10. That is 10.57 thousand, so 10,700 or $570. So it looks like a good project on the face of it, but I would not want to be in that bad demand scenario, right? And there's a high odds of that occurring. Still, it's like going to the casino, right? When I take both the outcome for a given pathway through the tree times the odds, even though there's higher odds of it doing bad, what I get from it doing good so outweighs that. It's got an overall positive expected NPV. It looks like a good project here, okay? Let's see what the option is, what we can do. Part B. If they take the investment today, there is an option to renew the franchise for 2 more years at the end of year 2. Pay an additional $20,000 franchise fee, and then get the same cash flows again, but in years 3 and 4.
I'm a little confused at the 23.4 times 0.4.
How's that? In what way? Did you get different numbers?
I got, when I multiplied it by 0.4, I got 9.35.
Because you should have. All right, so we're going to get, what do we get now? 935, 679. Okay, 256. So we still do the project. All right, let's see what this thing's going to look like. this one's gonna be pretty easy, I think, relative to some of the others that we've done. So this is gonna be with the growth option, all right? So there's no timing or delay. We're either doing it today or not. So 20,000 spent there, and then we get, so I'm just putting the same thing up here we had a moment ago. Like 25s, right? Those are 25s. Okay, so I just redrawn the tree, that's all I've done. Well, let's see. So if we end up in good demand, the upper branch, do you think we would go pay $20,000 at end of year 2 and do the franchise for another 2 years? Dude,
I mean,
you kind of iffy. Anybody more certain, like yes or no?
I think so. Yeah.
How come?
Because you know it's going to be high demand.
And
So-
because the NPV
It's positive.
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 NPV is positive, right? In that scenario, it looks good, so why not double down on your bet? So here's what's gonna happen then. Let me move this up a little bit. So here's what's gonna happen. So now we're gonna add a couple more years, because we're doing it for another 2 years. Okay? But to do it, we're gonna have to pay 20,000 right there. We'll get 25, but we'll pay 20 of it back to the franchisor, right? And that means just 5 right here. So the 25 we get from selling the hats minus the franchise fee. And then what happens? We get 25 a year for the next 2 years. 25, 5, 25, 25. Those are our cash flows. What about the lower branch?
You wouldn't do it.
Because why double down when things turn out bad, okay? We can't walk away from it. So that will stop right there. We say, you know what? We went in with great intentions, it didn't turn out good. Let's just walk away after 2 years. So let's see. Let's do our NPVs again, times our probability. Let's get the lower branch. It's not gonna change. 1132 times 0.6, so we still get the minus 6.79. We still get that. The upper branch, we gotta recompute our cash flows now. So let's see what we get here. All right, and we get on the upper branch an MPV of 42.72 million. And multiply it by the 40% odds, and we get 1709. And so now, $10.3 million expected NPV. Now, I gotta be honest, the way they put this problem together, the end result, the end interpretation is gonna be kind of unremarkable. And we'll see why. So we've got 2 outcomes here. We've got this one here, and we've got this one here, okay? Now, what would you guys have normally done? If this was a timing option, if the option was a timing option, you'd say, let's wait and see, right? If it was abandonment options, they say, well, heck, the abandonment option has value, yeah, so, but, and here we've got a growth option. It definitely increased the value by a fair amount, right? It almost quadrupled the value. But what's our basic investment decision gonna be in this project? What do you think? When?
Yeah.
Now, right? Which is interesting, this is why it's unremarkable, because this says invest now. That says invest now. It just simply means the growth option, the option to expand added more value. but it didn't change our investment decision, okay? The option made it worth more, but it didn't keep us from investing because it was good already. Let's do some what ifs up here. Let's say we've got the NPV with our option, so our growth option. So I'm just gonna put this one back up here. We had 10.3 NPV without the option. So it's just 2 years and done. And then we get our option value is the difference. It looks like that's, how much is that? 7.74. So invest today. In other words, our decision was only invest now or walk away. It wasn't to wait. And it didn't matter, the option made it worth more, but it didn't change our decision, so we still invest today. What if we'd had this? What if we'd had 10.3 and this had been a minus 2.56? We'd still invest today, right? But we only invested because we have this option to renew the franchise fee. Otherwise, it wouldn't be worth doing at all, right? So in that scenario, it doesn't change our decision, but it does tell us, here, it didn't really matter. I mean, I like that better, but it doesn't really matter whether I've got the growth option. It's a good project either way. But here, it kind of did matter because it's not even worth doing here. It's only worth doing if I have the option. So I'm still going to invest today. I can't imagine a circumstance where you would have this, where you would have a value with an option that is less than what you get without the option for a growth option. That won't happen. Because the growth option is to add on in the good state, right? So it's only going to increase the value. That said, what if we had that right there? What would the decision have been? Walk away now, right? Growth is either invest now or walk away. So reject the project. So growth and abandonment options is the typical analysis, right? You may have different expected NPVs to weigh, but it's either going to be invest today or don't invest today. The timing option will be either reject outright, invest today, or wait. And then last week, the sequential project would be either walk away now, it's all negative, or invest in stage 1, and then reevaluate what's left after that at the end of that stage, right, when time has passed. Okay, that's all of our math. We're done working these blasted things. Let's put this away, and let's look at this thing here real quick, see what's going on. All right, so let me expand this out a little bit more here. Okay, don't worry about this stuff up here. I'm trying to remember which project I used for this. At any rate, don't worry about this stuff up here. Look at option parameters here, and then the output down here. This is our NPV without the option. This is the NPV with the option in it, okay? So keep that in mind. So what we want to do is we want to look at these two numbers here. I'll expand this in a bit, and we want to see if I change something in here, one of these inputs. So I've got 6 inputs to my option model. I want to see what happens to these two values right here. It's specifically the NPV that accounts for the option. And I'm using what's called a Black-Scholes option pricing model. but one that has a little bit of an adjustment that allows for cash flows during the life of the option. So, what's S in a financial option? That's your stock price. And by the way, we're looking at this as a call option. We're not looking at put options, though they do exist. That's what an abandonment option is. This is a put option. We're looking at call options. So if you bought a call option on a share of stock, S would be the stock price, X would be the exercise or strike price. So those are two of our inputs. On a real option, this would be the present value of your future free cash flows. It's not your NPV, it's the present value of all the stuff excluding your cost. And then the exercise price would be your cost, which means that here, if you did S minus X for a real option, you get your NPV, right? Present value of your cash flows minus your costs, NPV. So that's your basic NPV without any option. There's going to be more inputs, but let's see what happens. It's a call option. Call option should increase in value when stock prices go up, or when you get more cash flows, or the present value of your cash flows is higher, right? So higher cash flows. So let's look at that. Let's see what's going to happen here. I've got cash flows of 3 million. Let's make them 5 million a year. And by the way, let's see what we've got. Let's just put some numbers down. My base numbers are NPV without is, say, 0.95 million. And then my NPV with my option is 2.63, just in case you guys can't see those numbers down there very well, okay? So the option adds some value down here. That's the number we're kind of looking at. Let's see what happens if I change the cash flows up here. I'm gonna make them higher. It should make everything more valuable. Sure enough, it increased both of those two numbers considerably, right? It increased the NPV. I got more cash flow. If I did that with any of these problems, it should make sense. If cash flows go up, NPVs would be higher. And so it made the NPV with the option higher, the NPV without the option higher. There's nothing particularly all that, there's nothing unexpected there. So higher cash flow should make a project worth more. What about higher cost? Let's put it back where we had it. What would happen if the cost went up? Probably make it worth less, right? So let me increase the cost from 20 million to 25 million. And now we get, both of my NPVs have gone down. In fact, the NPV without the option is now negative. The project's only good because I have an option embedded in this thing. It's still positive, but it's not as positive as it was before. So higher cost, make a project worth less. Again, that's sounds like common sense, right? I get more cash on the project, it's worth more. I pay more to buy the project, it's worth less. Okay? Those are pretty straightforward. Let's put that back to what we had. Okay. Option duration. Like how long? So option duration would be what? Kim Hotels, the option was a year. Remember that? The lumber company, the option was 2 years, because we could abandon in 2 years. FEF, the growth option, we could renew the franchise in 2 years. The option was 2 years. The longer you have to wait and see, the more time you've got for things to move in your favor on the option. It's worth more. It's worth more to have a year-long option than a one-day option. So this should have a positive impact. How long does the option last? Let's see what happens. I've got N set at 20 years. What if I made N, I've got my option duration set at 1 year. I've got 20 years of cash flows, but my option, maybe it's a timing option, is just 1 year, right? What if I make it 5 years? So, make it 5. Now, here's something interesting. So, let me put it back, 1, or not 0, 1, 0.95, 2.63, right? That's 1 year. Let's make my option last for 5 years. We have to make a decision. That didn't change. That number went to 5.34. It doesn't change the underlying NPV, that ignores the option. But it does change the value of the option, it increases it, okay? So that's why I have a positive right here. The longer you have before you have to make a decision on the option, to refranchise, to abandon the project, or to wait and see and make your investment decision, the more the option has value. All right, let's go set that back to 1 year. All right, we'll hit that one next. Let's look down here. Stock price variance. Now, your stats class, it's your sigma, right? Your volatility measure. Over here, it's cash flow volatility. Right? How volatile are the cash flows? So remember what we said, like we had expected cash flows that might be 3 million, the original problem, but they were really 3.8 or 2.2. That separation, 3.8 and 2.2, that's what creates variation in the project outcomes. What if I made them even larger? What if I made the gap more than 3.8 or 2.2? In fact, this is what this is. This is the Kim Hotels. That's what this thing is here, Kim Hotels. So I'm going to, instead of being 3.8 and 2.2, I'm going to make it a $1.5 million change. So now the cash flows are going to be 4.5 million for 20 years, or 1.5. And again, that NPV doesn't change, but the option value goes up. When projects become riskier, more uncertain, options have greater value. And then let's put that back. And let's look at 2 more things. Just give me 1.5 minutes here. I've got financing cost, and I got RFR, risk-free rate. The risk-free rate is my discount rate. In option models, you always use a risk-free rate. Let's don't take time to think about why we don't use the cost of capital here. It's our discount rate, okay? But what if that discount rate wasn't a percent? What if it was higher? What if it were, let's make it 6%. So again, I've got 0.95 and 2.63. It didn't change this number, but it changed this. It made it higher. So we'll put up here risk-free rate. It makes it higher. What is that? That is the discount rate that you're using to get your NPV. Your cost, you could say it's your risk-free cost of capital, okay? So what happens if your cost of capital goes up? It makes it, it should be a lower value today, you could say, but what it really does is it skews it towards waiting to see, right? It allows that option to have higher value. All right, let's reset that one, and let's look at one more parameter. Cash, I've got dividend yield. What's a dividend yield? It's your dividends divided by your stock price. Remember that? And here we've got something analogous in a, so if you were buying a stock option and it paid dividends, when you own the option, you don't collect the dividends. You only get them as a stock investor, not as an option investor. So to buy the option, you have the opportunity cost of not collecting the dividends, right? If you have a 2-year stock option on Apple, and Apple pays a dividend every quarter, and you wait 2 years to exercise your option, you've given up 8 quarters of dividends. Opportunity cost. If you're Kim Hotels and you wait a year to do the project, you're giving up a year's, you're waiting to get those cash flows. Opportunity cost, right? So we could put that in percent terms. The cash flows given up as a percent of the cost. That would be a yield, So let's say I've got 0, let's make the yield, let's see, 3 million a year, $20 million upfront cost. What is that? That's 1.5%, or that's not right. 20, yeah, that's 15%. Let's make a 15% opportunity cost. And it sounds like that should make things worse, because this is something I'm foregoing in order to take advantage of the option. So that lowered the option value. So my dividend yield has a negative impact. If I'm foregoing cash flows by waiting to see, the larger those cash flows, the more it hurts to wait, the less likely I'm going to. So those are the 2, 4, 6 different inputs in real options. They have an analogous component in financial options, right? Higher cash flows, more time, greater project risk, and greater discount rates make the option worth more. Higher cost and higher opportunity cost, cash flows you forego, waiting make it worth less, right? So I think we're done with everything. Sorry for keeping you here extra few minutes, but we're done, okay?